the top 5 asset classes that will dominate in 2026 and the one I'm avoiding. Hey everyone, Dr. Johnny Walker here, endodontist turned real estate investor and fund manager. Today, I am sharing my top 5 asset classes that I believe will dominate 2026 and the near future, and the one that I'm staying away from. Now, I'm not here to make wild predictions or hype up trends. This is my working investment thesis for our fund and for our investors for the next 5 to 10 years. And based on what I'm seeing across the economy, capital markets, and within my own portfolio. So let's start with the big picture. Now, we're entering a very tricky economic environment. Job growth is slowing, unemployment is slowly ticking up, even though the Federal Reserve has recently lowered rates with expectation for at least a couple more rate cuts. Even with that information, 10-year bond yields are still rising. And that's an early warning sign. You see, when bond yields rise, it means that investors are expecting more uncertainty. They're expecting inflation. Investors, as a result, are demanding higher returns in order to lend money to the US government. And as more countries like China and France begin pulling back from buying US debt, this continues to put pressure on bond yields to go up. You see, bond pricing and bond yields are inversely correlated. So when countries are pulling money out of the US bond market, this caused bond prices to go down. And as a result, when bond prices go down, bond yields go up and the cost of borrowing goes up. And the key to interest rates are based on the bond market, especially the 10-year, not what the Federal Reserve chairman decides. So when the headlines might say rates are falling, I truly believe that's temporary. Over the next few years, interest rates will trend higher. And then you throw inflation into that mix. Inflation has now become entrenched in our economy, and the government has signaled that we are going to accept this inflation. Even if the CPI, right, the Consumer Price Index, which is an index measuring inflation, comes in at 3 or 3.5%, that's still double the Fed's target. You see, we had 2% or less inflation for the last 25 years before the pandemic, but now inflation is significantly higher at 3 or 3.5%. And what that means is that there's an erosion of the purchasing power, and it hits everyone within our society, right? That means our dollar can buy 3% less goods and services. And here's what most investors miss. When inflation is sticky, equity prices and traditional portfolios suffer. We're expected to have very low growth in the stock market over the next 5 to 10 year period. And that comes counterintuitive because there's so much exuberance right now at a heavily weighted stock market, right? Stock markets at the time of this recording are hitting all-time highs, but price to earning ratios are much higher than ever. Warren Buffett index, all of these things tell us the stock market is vastly overpriced, and we're headed for very slow growth, especially during inflation time. So the question becomes, how do you protect your wealth when inflation eats at the dollar? Well, the short answer is you have to own real assets, things that generate cash flow and rise in value as the cost of living goes up. That's why real estate and certain types of alternative investments are going to shine in this environment. So with that context, let's get into the first of my 5 favorite asset classes. Now, these aren't ranked in any particular order, but let's start with one everyone knows. It's value add multifamily real estate, or large apartment buildings. There is a lot of pessimism around multifamily. A lot of people, including many dentists, investors, got hurt for deals that were done in 2021 and 2022, which was really the peak of the market, which is when the exuberance was at the highest. That's when sentiment was highest, interest rates were lowest, and people were overpaying for things. Now, what happened is there was a great reset, interest rates went up, and the people that got into deals in 2021 and 2022, all of a sudden were facing capital calls, defaults, foreclosure, and operators who overpaid using toxic floating rate debt. And that's exactly what happens at the top of every cycle. In reality, 2021, 2022 was the peak. And now we're entering the correction where the real opportunities start to appear, right? Now there's no interest in multifamily. Multifamily has gone from the peak of the cycle down to the trough. And I think we're slowly on the upswing again. But when we're in the trough and when we're on this just starting to correct, that's also when confidence is lowest. That's also when investors aren't paying attention. But that's when the real opportunities start to appear. Between 2021 and 2022, and at the time of this recording, the end of 2025, we actually expected a lot of foreclosures for 3-year floating rate debt mortgages that were purchased in 2021, 2022. That would mean the deals are starting to come to the end of their terms by 2024, 2025, and we actually expected to see a lot more distress than what we have seen. But lenders were also playing a game called extend and pretend, right? So loans that were supposed to be due 2024, 2025, they made some small modifications and they extended the loan, hoping that the borrowers can ride it out, hoping that interest rates that went up 450 basis points would slowly start to come down. But you can see in 2024, there were no rate cuts. In 2025, we only got a rate cut by Q3. So throughout 2024 and the beginning part of 2025, nothing was happening. But now that game is coming to an end. The time for extending and pretending is over. It is now time to face the executioner. Debt maturities are hitting. Banks are asking for their money. Valuations are resetting. Right? People paid top dollar in 2021, 2022. Those prices have come down, so people will have to sell at a loss. The distress is starting to bubble, and these are all the warning signs for the savvy investor. You see, for investors, that means we're about to see some of the best buying opportunities in multifamily we've seen in years. And remember, people will always need affordable housing. This problem isn't going away. Class B and Class C multifamily properties that are well managed and have solid value add plans will continue to perform well, especially as home affordability collapses. This is where cash flow, inflation protection, and demographic demand all intersect. This is exactly why multifamily is firmly in my top 5. There is an opportunity to buy prime multifamily real estate assets in excellent markets and submarkets at a 20 to 30% discount, which is historically significant. Next up, mobile home parks. Now this fits perfectly alongside value add multifamily. Both strategies afford the same problem: affordability and a lack of affordable housing. We know affordability is going to get worse before it gets better. New construction has stopped over the last couple of years. So what that means is more supply isn't coming on the market, but demand continues to grow. Within America, we are shortage of 6 million dwelling units, whether it's a house, apartment, condo, places for people to live. 6 million shortage. So there is starting to develop a supply-demand disequilibrium, which is a prime place to be as an investor. Whether that's buying or renting, mobile home parks become the safety net, right? People are priced out of traditional housing. They're even priced out of apartment buildings. As the economy slows, mobile home park becomes a safety net. This is one of the last true forms of naturally affordable housing left in America. Zoning restriction makes new development extremely difficult, so supply stays tight. And that means these assets not only cash flow well, but they also appreciate due to scarcity. And for investors looking to combine recession resistance, low turnover, and predictable income, mobile home parks are one of the most attractive opportunities over the next decade. Coming in next is self-storage, but with a little caveat. This asset class has its own individual cyclicality, and in certain metros, we've seen overbuilding. However, the opportunity in secondary and tertiary markets, the fundamentals remain very strong. Self-storage tends to thrive during times of transition, when people downsize, relocate, or face financial pressure. It's also closely linked to the same affordability trend we just discussed. And as people move into smaller homes or apartments, they still need a place for their belongings. And that's where storage demand holds up. Most importantly, self-storage assets are highly cash flowing with low operating costs, which makes them a great stabilizer in a diversified investment portfolio. In an inflationary or recessionary environment, cash flow is king, and self-storage checks that box. Now this one's very close to my heart, senior housing and care. We are entering what economists call the silver tsunami. Over 10,000 baby boomers in America turn 65 every single day. And that trend will continue for years. This demographic shift is massive, and it's creating one of the largest demand waves in real estate. Now, senior housing spans a spectrum of things. On one end, you have independent living communities that are specifically for 55 plus or 65 plus residents who are mostly self-sufficient, ambulatory, living in well-designed spaces built for comfort and community. Then you move into assisted living, where residents receive a bit more day-to-day help and care. And on the far end of the spectrum are nursing homes. They're highly regulated, they're staff intensive, and basically with medical facilities built into it. So it's a lot more advanced, complex business plan, but something that's in great need. Now, each level comes with its own risk and reward profile. But across the board, the macro trends are undeniable. As American population ages, this sector offers not only financial potential, but also the ability to create real social impact, helping our seniors live with dignity in their later years. And finally, energy. Specifically oil and gas. This one is less talked about, but incredibly powerful, especially for investors looking to hedge against inflation and reduce taxes. Oil and gas is a true cash flowing asset with the added benefit of massive tax advantages, including intangible drilling cost deductions that can offset active income like W-2. It's not trendy at all. It's not the latest AI data center play. Oil energy is essential for our economy, for our society, and it provides diversification not only from equities, but also from traditional commercial real estate. It's another non-correlated asset. And if you're a high income earner looking to build resilience into your portfolio, this is one sector worth studying. And if you want to learn more, I've got an entire video breaking this down in detail. You can find it right here on my channel. Now, what's the one asset class I'm avoiding right now? Data centers. Now, they're getting a lot of buzz. And don't get me wrong, the long-term story is strong. But in short term, I see signs of a bubble forming. Prices are being bid up aggressively, similar to what we saw in multifamily back in 2021. When everyone rushes into the same play at the same time, risk goes up. So for now, I'm watching that space, but I'm not allocating heavily there. In fact, I'm not allocating anything there. And since you guys have watched this far into the video, I'm gonna give you a bonus asset class. One that has a very bright future and is backed by government initiatives. And that is industrial real estate. We're gonna go into a deeper dive into industrial real estate in an upcoming video. So to recap, my top 5 asset classes for 2026 and beyond are value-add multifamily real estate, mobile home parks, self-storage, senior housing, oil and gas, and as a bonus, industrial real estate. Each of these sectors offers cash flow, inflation protection, and durable demand. 3 ingredients for long-term wealth. Now, if you found this video helpful, please hit the like button, subscribe, and drop a comment. And if you know other colleagues who would gain value from this video, share this video with them. Which of these asset classes are you watching most closely right now? And if you want to see how we're investing in these spaces or are interested in investing alongside us, join our free investor club at www.walkofwealth.com, W-A-L-K of wealth. The link is in the description below. And until next time, I'm Dr. Johnny Walker. I'm helping doctors and professionals turn their income into lasting wealth. And I'll see you on the next video.